Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about IBM, this legacy giant. It stands at a truly pivotal intersection of legacy stability and some very aggressive modernization. It's trading near $308 per share, and the company has delivered a year-to-date gain approaching 40%. That really defies the broader skepticism towards legacy tech and signals a pretty significant positive re-rating by the market.
And that re-rating saw the stock surge to 52-week highs, above $320 before settling into this consolidation in early December. But what truly warrants a deeper analysis here is the market microstructure. The mechanics of the trading accompanying this price action. We're seeing extraordinary institutional activity, specifically these off-exchange short volume ratios, consistently hovering between, say, 44 and 67% of total trading volume. That is a massive percentage that demands scrutiny because it tells us the current valuation is being held in this real tension between strategic optimism and some very specific financial mechanics.
Absolutely. And that tension is the core of our conversation today. IBM's valuation expansion is undeniably being driven by a massive strategic pivot toward enterprise AI infrastructure. The thing is, this whole shift is predicated on the $11 billion all-cash acquisition of Confluent, Inc. So the central question we have to answer is this. Does this aggressive, leveraged move truly secure IBM's future as an indispensable AI leader, or does the sheer cost create unacceptable financial and execution risk? I'm going to argue that this strategic purchase is essential to making watsonx viable, and critically, it is affordable, due to IBM's, its robust and defensible cash flow profile.
And I'm going to focus intently on the valuation paid, valuing Confluent at what is a demanding leadership multiple and the resulting immediate credit pressure that has already put the company in a precarious financial position if the integration of this expensive asset proves to be less than flawless.
Okay, so let's first articulate the bull case for this transformation. IBM has, moved past its boomer stock reputation and has earned its status as a critical utility provider for the specialized AI economy. The primary driver here is the enterprise AI thesis, which is different because it focuses squarely on data governance, security, and hybrid cloud deployment. Those are the three non-negotiable requirements for any Fortune 500 company trying to implement generative AI. The watsonx platform and Red Hat OpenShift are essentially the secure operating system for corporate AI.
The strategic rationale for playing in the secured enterprise AI space is sound. The demand for localized, compliant AI models that don't leak proprietary data is absolutely real. I'll concede that much.
And crucially, this transformation is being financed by the operational strength of the underlying business. We have to anchor this discussion to the balance sheet, not just the headlines. IBM is projecting a robust free cash flow, or FCF, guidance of roughly $14 billion for the full year. That FCF is the linchpin. It signals durable growth and stability without relying on painful equity dilution. So, the $11 billion Confluent acquisition buys the circulatory system of modern enterprise data, that real-time streaming via Apache Kafka, which is absolutely necessary to feed the demanding data requirements of watsonx and secure IBM's position at the core of the enterprise tech stack. It's an investment that unlocks future high-margin revenue streams.
That's a very compelling pitch for the necessity, but I come at it from a different angle when we talk about the cost and the financial strain. I acknowledge the strategic need for real-time data flow, but I'm going to argue that the staggering $11 billion price tag and the resulting financial risk, they outweigh the potential benefits, especially given IBM's history. That price tag is incredibly rich, valuing Confluent at approximately 15 times its forward revenue. That's a valuation typically reserved for, high-flying SaaS pure plays with 30% plus growth, not a legacy technology company attempting a pivot.
But that multiple reflects the fact that Confluent is the market leader in the data streaming space. You pay a premium for control of mission-critical infrastructure.
Perhaps, but the market certainly reacted. The financial mechanics of paying $11 billion in cash immediately triggered a reaction from S&P Global Ratings, who revised IBM's credit outlook to negative. They cited specific concerns that leverage will remain elevated at approximately 2.5 times adjusted EBITDA through fiscal 2026. This 2.5x ratio is not just a random number. It is a critical threshold that threatens IBM's long-held A credit rating. If that rating gets downgraded, the cost of capital goes up, which affects everything from bond issuance to everyday operational expenses. And on top of that, analysts are skeptical maintaining sell ratings, precisely because this high acquisition cost introduces significant short-term dilution risk to earnings per share and free cash flow, projecting price targets, significantly below current levels.
That brings us squarely to the technical headwind you identified at the beginning, the market microstructure. We have to clarify what that high short volume actually means because it's a source of constant confusion for investors. You pointed to the exceptionally high dark pool short volume, above 60% on some days, and suggested this suppresses the rally, aligning it with negative sentiment or simply arbitrage.
Well, I wouldn't say it's negative sentiment, but let me give you a more nuanced perspective on the arbitrage. That extraordinarily high off-exchange short volume perfectly aligns with arbitrage dynamics. Since the deal is all cash, arbitrage funds buy Confluent stock to lock in the spread, and crucially, they short IBM shares as a hedge. They short the acquirer to hedge against regulatory failure, a crucial risk given the size of this deal and the current FTC scrutiny, or unexpected closing delays. This mechanical short selling acts as a sustained technical ceiling on IBM stock price, often capping the rally around $315 regardless of the internal bullish sentiment. It's a short position driven by hedging, not outright pessimism, but the result is the same: downward price pressure.
That's a meticulous explanation of the arbitrage mechanism, though I would frame the implication of that dark pool data differently. I'm just not convinced that the high dark pool short volume, even if it's partially arbitrage-driven, overrides the signal of large-scale institutional conviction. For a liquid large-cap stock like IBM, we have to distinguish between high daily short volume flow and long-term short interest.
Okay, so how do you differentiate the two in this context?
High dark pool short volume, particularly when it's coupled with strong institutional buying, often signals massive institutional accumulation. Think of the plumbing. When a large fund wants to accumulate, say, $100 million worth of shares over a week without spiking the price, they transact through a market maker in a dark pool. The market maker instantly and temporarily sells the shares short to fill that massive long order from the fund. Then that market maker goes to the lit exchanges over time to cover their short position. This high ratio simply indicates that market makers are shorting heavily as a service to facilitate massive, confident long accumulation by large funds positioning themselves for the 2026 fiscal year rebound. So to my mind, this is actually a validation of institutional confidence in the AI pivot, despite all the arbitrage noise.
That clarifies the two competing forces in the tape: the arbitrage hedging versus strategic accumulation. But even if we assume the institutional buying wins out, it just drives us back to the primary risk. Can Big Blue actually integrate a company valued at this level? And before we pivot fully to that operational risk, there's one minor but persistent confusion point we should probably clear up, since it relates to the legacy status of the company.
You're referring to the reverse split myth that permeates all the retail chat forums.
Exactly. We should just state definitively for our listeners, IBM has not executed a reverse stock split in recent history, which is, a common sign of a distressed company. That whole narrative is false.
The confusion stems entirely from it really comes from the November 2021 Kyndryl spinoff. That corporate action saw shareholders receive 1 share of Kyndryl for every 5 shares of IBM they owned. When IBM shed that low-margin legacy infrastructure business, the IBM price chart had to gap down to reflect the value that left the company. So that chart movement, which was actually a strategic divestiture of value, is often misinterpreted by unsophisticated observers as a reverse split, which is a sign of desperation. The reality is far more complex and involves a strategic shedding of assets.
A crucial distinction, indeed. Now, let's get back to the strategic necessity. You argue that Confluent is mission-critical for watsonx. Why is real-time data that important right now, specifically for enterprise AI?
It's the difference between legacy AI and compliant Gen AI. Legacy systems relied on batch processing. Data was collected, cleaned overnight, and then fed to models in bulk. But enterprise AI, especially for highly regulated industries like banking or healthcare, it requires instant feedback loops for governance and security. Confluent's Kafka technology provides that low-latency, real-time data streaming infrastructure. If a financial institution is using watsonx for risk assessment, they need to ingest transactional data instantly to monitor for fraud or compliance breaches. You simply cannot wait 24 hours. Confluent isn't just nice to have, it is the prerequisite for running compliant, trustworthy AI at scale within the Fortune 500. Without it, watsonx is a limited product.
I fully agree on the strategic imperative of real-time data flow for modern AI governance. I do. However, the risk lies in the execution. You claim the Red Hat deal provides a successful template for integration, minimizing cultural clash. I'm sorry, but I just don't buy that the Red Hat deal fully mitigates the risk here.
I see why you think that, but why do you view this integration as fundamentally different?
Because we need to look at historical precedent and the cultural context. Red Hat, though it was open source, operates largely in the infrastructure layer. It was providing the foundational operating system for cloud environments. Confluent is focused on the developer and application layer. It's fast-moving, it's built by developers for developers, and its strength is in innovation. IBM has a mixed and often poor track record with M&A, citing failures like the lack of ROI from SoftLayer or the ultimate divestiture of Watson Health. The sentiment among the core developer community is palpable. There is a genuine fear that IBM's corporate bureaucracy, its rigid processes, will stifle Confluent's innovative open-source culture.
That risk of the IBM touch, as detractors call it, is definitely present. But management is aware of it and has actively stated they plan to operate Confluent autonomously, very similar to the Red Hat structure.
Autonomy is promised, but it's often not delivered when financial pressure mounts. If key talent and founders leave, the $11 billion ROI quickly deteriorates. It's a simple retail critique, and though it's simplistic, it still rings true. Why pay $11 billion for something you can download for free? That question highlights the fact that IBM is paying for the managed services and the talent around Apache Kafka, not the underlying open source code itself. If the culture and talent are destroyed by the integration, the deal is a massive overpayment. It feels like buying an expensive luxury car and then forcing it to drive like a heavy-duty truck.
The sticker shock is necessary to acquire the market leader in a niche that is strategically indispensable. But this operational risk leads us directly back to financial flexibility, which I view as far more resilient than you do. The question of the dividend sustainability is a cornerstone for long-term investors.
And that is precisely where the S&P warning lands its hardest blow. The $11 billion cash outlay significantly narrows IBM's financial flexibility. While the current $14 billion in FCF guidance comfortably covers the $6.1 billion annual dividend payment, I'll acknowledge that coverage. The negative outlook from S&P is a genuine warning shot regarding the debt structure.
Let's just clarify for the listener. What does S&P's 2.5x leverage threshold actually mean in concrete terms for IBM?
So S&P assigns credit ratings based on a comfort level of debt relative to cash flow, or EBITDA. An A rating is considered upper medium grade. Maintaining that rating requires IBM's debt-to-EBITDA ratio to stay well below that 2.5x mark. Crossing that threshold, as S&P predicts they will, means that the time it takes a company to pay off its debt from operational earnings is expanding beyond their acceptable parameters. This forces management into a difficult choice. If macroeconomic headwinds hit the cyclical consulting segment, or if the Confluent integration stumbles, IBM may be forced to dedicate more of its FCF toward deleveraging, paying down debt aggressively, just to save the A rating. This would occur potentially at the expense of maintaining its 29-year streak of dividend increases in 2027. This is a very real tension between saving the credit rating and maintaining capital returns.
I acknowledge that the leverage ratio is the metric to watch, but I believe the threat is overblown precisely because of the durability of IBM's core businesses. The dividend is absolutely not an immediate danger. The FCF coverage ratio is comfortable, and we cannot ignore the incredibly sturdy revenue floor provided by the infrastructure segment. The Z16 mainframe cycle continues, and the anticipated Z17 cycle in late 2025 or 2026 acts as a powerful call option on future revenue spikes. Those mainframe systems are sticky, proprietary, and they're mandatory upgrades for major financial institutions globally. This provides a resilient, predictable layer of FCF.
That mainframe cycle is cyclical and dependable, yes, but it masks the slower growth in other areas.
But this strategic investment in Confluent is a necessary tension between capital returns and aggressive capital investment. IBM is rightly prioritizing future margin expansion now that it has shed its low-margin dead weight, like Kyndryl and the bulk of Watson Health. This strategic focus demands capital expenditure now to ensure higher FCF in 2026 and beyond. A brief increase in leverage is a reasonable trade-off for capturing the AI infrastructure market. They are paying a high price because they simply cannot afford not to own the data flow.
It demands flawless execution and a little luck on the macro front, something they haven't always enjoyed. The question for investors is whether they trust management to thread that needle perfectly, navigating high integration risk while managing a credit rating that is under pressure.
So to summarize my position, I see a powerful compounder thesis emerging. IBM is successfully shedding legacy structural risks and acquiring key high-growth indispensable assets. The company is positioning itself as the secure, cash flow positive player in the high-stakes AI infrastructure market. It offers a substantial margin of safety, trading at roughly 22 times forward earnings, compared to the broader software sector, which often trades above 30 times. The risks are entirely manageable, in my view, given the scale and defensibility of that projected $14 billion in free cash flow.
Conversely, I conclude that the bullish transformation relies entirely on flawless execution, which is historically difficult for Big Blue. The current price reflects not only the hope of synergy, but also significant inherent risks, including heightened regulatory scrutiny from antitrust regulators, and the material challenge of preserving Confluent's unique innovative culture. The valuation remains exceptionally high, and I'll reiterate that the elevated leverage ratio near 2.5x is the crucial financial metric for listeners to monitor heading into 2026. This is a bet on execution, not merely on strategy.
What this all boils down to is a tough choice for investors, weighing the certainty of that massive $14 billion in annual cash flow against the high cost and inherent operational risk of this massive strategic pivot into the core of the AI economy.
Indeed, it is a calculation of security and defense versus accelerated growth at a demanding price.
So we have explored two competing narratives today. IBM is a resilient AI infrastructure compounder whose substantial cash flow cushions the financial and operational risks, versus IBM as a high-risk company whose future hinges entirely on the successful, leveraged integration of Confluent under intense market and regulatory scrutiny.
A fascinating time for the company, and certainly for its shareholders and credit holders alike.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.